Have you ever looked at a company like Tesla and wondered, how on earth do they account for a gigantic new factory? Or, how does Amazon get its massive fleet of delivery vans onto its books? Well, today, we're going to follow the life of a company's biggest physical assets. We're going to trace them from the moment they're bought to the day they're retired. And you'll see how the choices accountants make can totally change a company's financial story. So let's get right to it. Imagine a company goes out and buys a brand new $1 million robot for its factory. How does that massive purchase actually show up on its financial statements? It's definitely not as simple as you'd think, and the decisions made right at this first step can ripple through a company's profits for years to come. All right, so that robot, the factory it sits in, those delivery vans we talked about, they all get bundled together under one official, kind of clunky name. In the world of accounting, it's called property, plant, and equipment. Most people just call it PPE for short. So what does it take to get into the PPE club? Well, there are three main roles. First, it has to be tangible. You got to be able to reach out and touch it. Second, it's used to actually run the business, not something you're planning to sell. And third, it's got to last for more than a year. Our $1 million robot? Yeah, it checks all three of those boxes, no problem. Okay, so we've identified our asset. Now for the big question, what is it actually worth on the books? The very first step is figuring out its initial cost. And here's a spoiler, that number is almost always bigger than what was on the price tag. The whole game is guided by this one principle called historical cost. Now, the most important part of this definition is that little phrase, all costs incurred. We're not just talking about the sticker price. We are talking about literally every single penny that was spent to get that asset in the right place and ready to do its job. So what does all in really mean? Well, think of it like a checklist. You start with the price you paid for it, then you add on the shipping costs, any fees for installation, the cost of testing it to make sure it works, and you even include the interest you paid on a loan if you borrowed money to buy it. All of that gets bundled up into one single number, the historical cost. Let's make this real with our case study, Jayhawk Company's new robot. They paid $850,000 for the machine itself, but then they had to spend another $150,000 on installation and testing. You add those two together, and the actual cost that goes on the books isn't $850,000, it's a full $1 million. Now, we all know that $1 million robot isn't going to be worth $1 million forever, right? It gets used, it gets worn out, new technology comes along. So how do accountants deal with that slow decline in value? This brings us to the next stage in the asset's life, the whole concept of depreciation. Okay, I know this definition looks a little academic, but the key word here is allocating. This is so important. Depreciation is not about figuring out exactly what the robot is worth on the open market each year. It's an accounting process for taking that initial $1 million cost and spreading it out as an expense over all the years the robot is expected to be useful. And this formula is how it all looks on the balance sheet. The value that's shown, which is called the carrying amount, is just the original historical cost minus all the depreciation that's been recorded so far. That running total of depreciation is called accumulated depreciation. So every year, accumulated depreciation goes up and the carrying amount of the asset goes down. Simple as that. To actually calculate that yearly expense, accountants need three key ingredients. First is the depreciable base. That's the total amount you're allowed to depreciate. You get it by taking the historical cost and subtracting what you think you can sell it for at the very end, its salvage value. Second, you have to estimate its useful life in years. And third, and this is where it gets really interesting, you have to pick a depreciation method. That's right. There isn't just one way to do this. Companies actually get to choose from several different methods, and believe me, their choice has a huge impact on their financial statements. So now we're going to look at 4 different ways a company could depreciate the exact same robot using totally different math each time. First up, we've got the most popular and easiest method of them all, straight line. The name pretty much says it all. You just take the total amount you need to depreciate, and you divide it evenly over the asset's useful life. You get the exact same expense year in and year out. It's predictable, it's simple. Let's go back to Jayhawk's robot. Its depreciable base is $900,000, and it has a 5-year life. Using the straight line method, you just divide $900,000 by 5. And what do you get? A super consistent depreciation expense of $180,000 every single year. Nice and easy. But what if that robot works like crazy in some years and barely does anything in others? Well, our second method, units of output, is perfect for that. Instead of being based on the passage of time, this method ties the expense directly to how much the machine is actually used. The more it produces, the more it depreciates. And you can see exactly how that plays out for Jayhawk right here. In year 1, the robot was running full tilt, producing the most units, so it had the highest expense, over $258,000. But then, look down at year 5. Production dropped off, and the expense fell all the way to just over $78,000. The expense is a perfect mirror of the machine's workload. All right, next up are the accelerated methods, like double declining balance. The logic here is pretty simple. An asset is usually most efficient and loses its value the fastest when it's brand new. So these methods front-load the depreciation expense, hitting the books with a much larger charge in the early years. This can actually be a pretty smart strategy to lower your taxable income sooner. And wow, you can really see the impact here. Just look at year 1, a massive $400,000 expense. Remember, the straight-line expense was only $180,000. With this method, the expense is huge right at the start and then drops off a cliff in the following years. It's a very top-heavy way to do it. Our last method is another accelerated one with a really weird name, sum of the year's digits. Now, the math is a little different. It uses a declining fraction each year, but the goal is exactly the same as the last one. Recognize way more of the expense early in the asset's life. And when we apply this method to the Jayhawk robot, you see the exact same accelerated pattern we just saw. The expense starts high at $300,000 in year 1, and then it steadily goes down from there. It's just another way to match those higher expenses with the years when the asset is at its peak performance. Okay, this slide is where it all comes together. Just look at this. For the exact same robot in its very first year, the company could report a depreciation expense as low as $180,000 or as high as $400,000. Just think about that. That's a $220,000 difference in reported expenses, which flows directly to the bottom line and changes the company's reported profit. This single choice is a huge deal. But the story isn't over yet. The asset has been purchased, it's being depreciated, but what happens when you spend more money on the robot down the line? Let's look at the last piece of the puzzle, deciding if that new cost is a major upgrade or just a basic repair. The rule is actually pretty straightforward. If the money you spend actually improves the asset or makes it last longer, like giving our robot a brand new, faster arm, that's a capital expenditure. You capitalize it, which just means you add that cost to the asset's value. But if you're just doing routine maintenance, like an oil change, that's a revenue expenditure, and it gets counted as an expense right away. It's really the difference between a major upgrade and a simple tune-up. So as we've seen, accountants have choices, and those choices have very real consequences. Which brings me to a final question for you. Now that you know the methods, if your goal was to claim the biggest possible expense in the first year, and by doing that, lower your taxable income as much as possible, which method would you choose? It's decisions just like this that prove accounting isn't just about looking backward. It's a really powerful tool for shaping business strategy. Thanks for watching.